What if I told you that your money could make money for you? That's the power of compound interest. It's one of the most important concepts in personal finance, and it's something that can truly transform your financial future. Here's how it works. Compound interest is when you earn interest on both the money you invest and the interest that your investment has already earned. So over time, your investment starts to grow faster and faster, even if you don't add any more money. It's like a snowball rolling downhill. It picks up speed and size as it goes. Let's say you start with $1,000 and earn 5% interest per year. After the first year, you'd have $1,050. But the next year, you're earning interest on $1,050, not just the original $1,000. And that extra interest continues to build year after year. The longer you leave your money invested, the more it grows, thanks to compound interest. The key to making compound interest work for you is time. The earlier you start investing, the more time your money has to grow. Even small amounts, invested early, can turn into big sums over the long term. That's why starting as soon as possible is so important. You don't need a lot of money to begin. Even if you're only able to invest a small amount each month, the key is consistency. Keep investing regularly and let compound interest do the rest. Over time, those small investments will grow into something much bigger. And here's another tip: reinvest your earnings. When you reinvest the interest or dividends you earn, you're maximizing the power of compounding. Your money is making more money, and the growth becomes even faster. Remember, compound interest works best when you give it time. It's not a get-rich-quick strategy, but it's a sure way to grow your wealth over the long term. The sooner you start, the more you'll benefit from the magic of compounding. So, start today. Whether it's a small investment or just learning more about your options, take the first step. Your future self will thank you for letting compound interest work its magic. In this next part, let's expand on how you can maximize the power of compound interest even further. One of the best ways to make compound interest work for you is through long-term investing. Start by choosing investments that are likely to grow steadily over time. Stocks, index funds, and mutual funds are great options for long-term growth. They might have short-term fluctuations, but historically, they've provided strong returns over many years. The longer you leave your money invested, the more time compound interest has to work its magic. This is why starting early is so important. Even if you can only invest a small amount now, that money will have years, or even decades, to grow. Next, be consistent. Set up automatic contributions to your investment accounts each month. This way, you're consistently adding to your investments, and over time, the compounding effect becomes even more powerful. It's also important to avoid the temptation to pull your money out too soon. With compound interest, patience is key. The longer you stay invested, the more your money will grow. Avoid selling during short-term market dips and keep your eye on the long-term goal. Lastly, remember to reinvest your earnings. When your investments pay dividends or interest, reinvest those gains back into your portfolio. By reinvesting, you're letting compound interest work at an even faster rate, allowing your money to grow exponentially. Compound interest is a powerful tool for building wealth, but the key is to stay patient and stay invested. By taking a long-term approach and letting your money grow, you'll be amazed at how much your investments can grow over time. So, keep investing regularly, stay patient, and let compound interest do the heavy lifting for your financial future. In this part, let's talk about how to make compound interest work for your retirement. Saving for retirement is one of the best ways to take advantage of compound interest over a long period of time. One of the easiest ways to get started is through retirement accounts like a 401k or IRA. These accounts allow your money to grow tax-free, which means your compound interest can grow even faster. Many employers also offer a match on 401k contributions, so take advantage of that if it's available. That's free money that adds to your investment. The key to retirement investing is starting early. The more time your money has to compound, the larger your retirement nest egg will be. Even if you start small, the earlier you invest, the more significant your results will be in the long run. Another great tip is to increase your contributions over time. As your income grows, try to boost the percentage you're putting into your retirement account. This allows you to take full advantage of compounding during your peak earning years. Diversify your retirement investments to reduce risk. Consider a mix of stocks, bonds, and other assets to create a well-balanced portfolio. The goal is to achieve long-term growth while minimizing risk, and diversification is key to that strategy. Lastly, don't panic during market downturns. It's normal for markets to go up and down, but staying invested through the ups and downs is what allows compound interest to work over time. Avoid withdrawing your money early, as this will interrupt the compounding process and could result in penalties for early withdrawals. Let your investments grow steadily, and when retirement comes, you'll have built a strong financial foundation thanks to the power of compound interest. Now that we've covered how compound interest helps with investing and retirement, let's talk about how it applies to everyday savings accounts. Even the money you put in a simple savings account can benefit from compound interest. Most savings accounts in banks or credit unions offer compound interest, meaning the interest earned is added back into your account balance and begins earning interest itself. This helps your money grow, even if you're not actively adding more. To maximize the benefits, look for high-yield savings accounts. These accounts offer higher interest rates compared to traditional accounts, allowing you to earn more interest over time. Remember, consistency is key. The more you regularly deposit into your savings, the more compound interest has to work with. Even small contributions, when made consistently, will grow into larger amounts thanks to compounding. Make sure to let your money sit and grow. The longer your savings stays in the account, the more interest it will earn. This is especially helpful if you're building an emergency fund or saving for a long-term goal like buying a home or taking a vacation. Another tip, look for accounts with no fees. Some savings accounts charge maintenance fees that can eat away at your earnings. High-yield accounts without fees are the best way to maximize the power of compounding. Even if it's not a large amount, the compound interest earned on your savings account over time can make a noticeable difference. It's a slow but steady way to watch your money grow. By combining the power of compound interest with regular deposits, you can achieve your savings goals faster. Finally, let's talk about how to harness the power of compound interest for your children or future generations. Starting early, even from a young age, can give them a significant financial advantage as they grow older. One great way to do this is by opening a custodial account for your child. This allows you to invest on their behalf, and as the money grows, it earns compound interest over time. By the time they're ready to access the account, it could have grown significantly thanks to years of compounding. You can also teach children about saving and compounding by setting up a savings account for them. Help them understand how regularly depositing even small amounts can make a big difference over time, and watch their excitement grow as they see their money increase with interest. Another option is starting a 529 plan, which is an investment account specifically for education savings. The earlier you start, the more time compound interest has to grow the funds, helping cover future education costs like college tuition. The power of compound interest can have a huge impact when you start early. By encouraging children to save or invest from a young age, you're setting them up for financial success and helping them build a strong foundation for their future. It's never too early to harness the power of compound interest, and the earlier you start, the bigger the rewards will be. Teach your children these principles, and they'll benefit from the magic of compounding for years to come. In this part, let's explore how to apply the principles of compound interest in real estate investing. Real estate can be a powerful tool for building wealth, and compound interest plays a key role in that process. When you invest in real estate, you can benefit from compounding in a few ways. First, through appreciation, where the value of the property increases over time. The longer you hold onto the property, the more it's likely to appreciate, meaning your investment grows. Next, rental income. If you rent out your property, the income you receive can be reinvested. You can use the profits to pay down the mortgage faster or reinvest in other properties, allowing your wealth to compound over time. Mortgages themselves benefit from compound interest too. Paying off your mortgage early or making extra payments can save you money on interest, allowing you to build equity faster. The more equity you build, the more your investment grows. Real estate also offers the advantage of leverage, where you use borrowed money to invest. This means you're compounding your returns by using less of your own money and more of the bank's, allowing for higher returns over time. By combining appreciation, rental income, and leverage, real estate investing offers multiple ways to harness the power of compounding. Stay patient, invest wisely, and let time do the heavy lifting as your investment grows. In this final part, let's dive into using compound interest for wealth building through dividend investing. Dividends are payments made by companies to their shareholders, and they can be a powerful way to grow your wealth over time. When you invest in dividend-paying stocks, you can reinvest the dividends back into buying more shares. This increases the number of shares you own, which, in turn, generates even more dividends. That's compound interest in action. Over time, this process accelerates your wealth growth, with your dividends working for you by producing even more dividends. One of the best things about dividend investing is that you don't have to rely on stock price appreciation alone to see your investments grow. Even in times of market volatility, dividends can provide a steady income stream. To maximize the impact of compound interest with dividends, consider investing in companies with a history of increasing their dividend payments. As these companies grow, so do their payouts, meaning you'll be earning even more over time. It's also important to be patient. Dividend investing is a long-term strategy. The real power of compounding comes from reinvesting dividends over years or decades. The longer you stay invested, the more significant the growth will be. By harnessing the power of compound interest through dividend investing, you can create a reliable stream of income and build lasting wealth. It's a simple but effective way to let your money grow steadily over time.